Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Wednesday, the 8th of February. I'm Daniel Lam, your host for the podcast. Last weekend, I was taking chess lesson from my German grandmaster coach, and I made the analogy that Bobby Fischer was like Iceman, while Boris Spassky, who lost the famous World Championship match against Fischer in 1972, was similar to Maverick. Now, for those of you who have watched the movie Top Gun, you would most likely agree that, in an orthodox sense, Iceman was the better fighter pilot than Maverick, much like Fischer was fundamentally the better player. But Maverick was capable of springing surprises that few would have expected, much like the charismatic Spassky. In the investment world, European equities have been the Maverick or the Spassky amongst equities for the last few months. Why? Well, because in the orthodox sense, there are real fundamental issues with Europe, namely inflation that is caused by the Russian-Ukraine war. However, the warmer than expected winter managed to mitigate some of the concerns there, and the China reopening had also helped European exporters. So now, what should you be doing with European equities after their outperformance versus US equities for the last 4 months? So on the plus side, EU economic growth surprises continue to be trending higher and outperforming those in the US. And this often feeds into equity positioning. Also, longer-term momentum signals have turned positive for European stocks, which brings systematic buyers back to the table. However, on the flip side, Euro area relative valuations versus bonds are no longer attractive in risk-adjusted terms after the rally in the last 4 months, and there are early signs of divergence between the relative strength index, i.e. the RXI, versus the Euro Stoxx 50 index, meaning that the index had been making highs, but the RSI have not been gaining in strength. The saving grace on that front is that there has still been increasing volume buying on European equities and relatively mild volume on the pullbacks. Nonetheless, we view this as an amber signal from the RSI. On balance, while there could still be some upside for European equities, the Euro Stoxx 50 index is approaching key resistance levels, which are 4,288 and 4,396. Investors should consider rotating into Hong Kong China equities if the Hang Seng Index pulls back to the key support levels at 20,300 and 19,300. That is all from me for today. As always, if you enjoy this podcast, please do not forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.